conservative income investors having their bonds come due that were yielding 4%, or their CDs coming due that were yielding 4%. And all of a sudden they're offered 40 basis points for those same CDs that were getting 4%. Where are they going to go to subsidize their cash flow?
So since there is no alternative, what are some ideas that you have now that you've been advising?
Well, first of all, it's about risk, right? You're taking money coming from a far less risky portion of their portfolio to a far more risky portion of the portfolio just to subsidize their cash flow. So these type of stocks aren't going to light your hair on fire. We're looking for consistent dividend growth. We're looking for consistent cash flow and some type of lower volatility so that these type of investors will at least somehow be able to put bread on their table and not have to rely on 40 basis points in a CD.
Right. So I know you're looking at the high yield ETF. You have several things that you're looking at. Explain some of those options, right? I saw VYM, Yield, SCHD. Tell me about some of those. And I know there's some great companies within those.
Correct. And they're yielding anywhere from 3 to 3.5%, 4%. And again, you're getting a basket of high yield dividend paying stocks, primarily value. And again, what's good about this market is we're finally starting to see the market branch out a little bit. In the last month, we're finally starting to see value, small cap, and what have you, which makes us feel a little bit better. So therefore, those are the type of stocks that are paying dividends. They're not the glamour stocks, but at least you're going to get paid for the risk, and you're also going to get paid the wait. And if we can grab 4, 5, 6% in capital appreciation, plus a 3 or 4% dividend over a 12-month period, that's a nice rate of return for a conservative investor.
Right. And then moving on to you mentioning, paid while you wait, we go from those high yield ETFs to actually some dividend paying stocks. And so those are some exciting names too, including Verizon and Pepsi, right?
Oh, yeah. Well, Pepsi, I guess, is a consummate COVID-19 stock to be in, right? I can attest to that from a personal experience, sitting there eating Doritos and Cheetos and wishing that my gym was going to open up pretty soon. But it's a great stock because you're getting a 3% dividend, very defensive. They've increased their dividend for, I think it's been over 47 years now. And I think that when you look at a Pepsi and a Verizon, and again, you're talking about conservative investors here, so it would be a good idea to dollar cost average into these type of companies. Don't go in all at once. Because if you remember in 2015 and 16, a lot of TINA investors, if you will, they were forced to go into an avenue they shouldn't have gone into, and that is put a lot of money into MLPs without diversifying their portfolio. And yes, you got your dividend of 5 or 6%, but you were down 40 or 50% in capital. So guess what? You can look at yesterday with Pfizer. Pfizer is yielding a 4% yield. A lot of people flew into Pfizer because of that dividend, and yet yesterday it gave up 2 years worth of yield. Now, that's just a snapshot in time, but it's something to be cognizant of when conservative investors go into common stock.
Let's stay on health and pharma for a second, Tom, because I know you have a couple of other picks in that area, Johnson & Johnson and AbbVie. I know this group has been, people are really liking this group for so many reasons, of course, in the battle against COVID, but J&J and AbbVie are two great companies. AbbVie has had a lot of news lately. Your thoughts on those, because those are some names that you have as your stock picks.
Yeah, AbbVie, of course, just completed its Allergan merger, which has finally diversified their pipeline away from Humira, which is up over 54% of revenue with one stock. Allergan, of course, brings Botox to the forefront and into the portfolio for them. And there's sure a heck of a lot of back orders or backlog for Botox users since we've been in the shelter. So that's good for the future. Pays a 5% dividend, great cash flow, a lot of debt. Don't get me wrong. They had to float a $30 billion bond offering, if you remember back, I believe it was in November. And they had roughly $80 billion in debt. But cash flow, free cash flow should take care of that dividend. So we don't find that a problem. At this point in time, you've got J&J, which is the defensive of all defensive stocks. Obviously, they've got problems as far as lawsuits. We feel that's fully discounted in the stock regarding the talc situation. And it is only one of 2 AAA rated companies left in the country. Hard to believe.
Yeah. All right. Well, I hope you get back to that, Jim.